KTN News. Get the whole story.
So welcome back. You're watching the Trading Bell, and I'm here with Kevin Gigi and Gijohi himself, all the way, just helping us to understand the year, how it has been, and what are we seeing as we cross over. We are talking about the interest we have seen on the corporate bond sector, talking about what we saw with Family Bank and EABL. Gijohi, I don't know, what's your comment on this? Is this a new rise that we're seeing with interest from investors?
Well, I think investors looked more at the quality of the companies that were issuing the corporate bonds. We've seen a corporate bond drought for quite a while. And of course, before that, we saw quite a few corporate bonds that went bad. I think there was Chase Bank, and there was Imperial Bank. And so investors had become very averse to those. And so I'm glad that we did see oversubscription and a very good response of investors to those two corporate bonds. Means there is an appetite now, and of course, if they're well structured, it could be a good thing for that market. Of course, there's still that worry. Corporate bonds are very illiquid on the secondary market, and so we hope that this new surge will also help to see more activity on that end.
And it's also a way to, I think just for me, it's also a way to diversify. Because if you look at investment funds, they're predominantly in two things. So they're in the stock exchange, or by that I mean equities, or they're in government securities, government debt. So traditionally we had seen a couple of good bonds, especially from EABL, Then they went for a time where they sought other funding channels. So we saw quite some drought. Then I think the last few corporate bonds that again we had, as Gisha mentioned, we had Chase and Imperial and a few others went bust. So guys were really, because the level of trust that you bestow to corporate bonds is not the same you give to government debt. Government debt is backed by the sovereign, you know. Corporate bonds, you can only go for so far before you're wiped, So with the back of companies again, such as EABL in the last few years, and now, you know, Family Bank and a few others, I think there's just that investor optimism and hope, and also a way to diversify from the two classifications of investments. So
we are likely to see some more next year.
We could see some more, and it's a cheaper way for them to also finance. You know, if you're going to a bank at 13.5%, and you can get it from the market at 11%, I mean, it's cheaper for the companies.
All right, so I just want to start with you, Kevin, to comment about this day trading. We saw the launch of day trading right here. Apparently, from hearsay, it's a game changer in itself. I don't know, what has been your observation?
Game trading was poised to be a game changer. To me, it hasn't really come close. It's all the, you know, the excitement and hula baloo about a new investment, but it doesn't really take off from where we're seated. So we earlier on saw derivatives. If you look at the turnover derivatives, I mean, it's ludicrous. It's a joke. It's neither here nor there. Derivatives market is one of the biggest markets in the world. I think the biggest market in the world.
And how are we doing here?
We're not doing quite well. You know, we're talking about 200,000 turnover a day. When you go to the market, you're talking about trillions of dollars in turnover a day. Because almost everything can fit into a derivative, and that can become a commodity. You know, so it's a very big market out there. It's a really unexplored market in here. Partly, or in part, it's because, you know, we have very countable securities, you know, the single stock futures and index futures, and that's just about it. You know, we have a gold trading on the main board. We don't have a derivative for that.
Let me bring in Gijohi on that, because what should be the call to action? Because, you know, the instruments are there. Why are people not really excited about taking these things up?
One, the biggest issue is the level of sophistication. We are coming from a market where a majority of investors are dividend-related investors. Very few investors are actually sitting in what we call pooled funds. Most investments are individual retail CDSC accounts. I mean, we have about 1 million CDSC accounts in comparison to South Africa, where there are very few, much less in the number of CDSC accounts, because they have a lot more in terms of pooling of funds, which now means that the fund can diversify into different, you know, the different securities, and with some underlying knowledge of the market, because it means it's being managed by somebody who understands the market. So I think a lot of investor education about these things is important. Kenyans don't pick something new like today and tomorrow they're running for it. They're usually very, very cautious with any new investments. Remember, we have seen so many scams in Kenya, and Kenyan investors always feel that anything new until, yes, unfortunately. So it's not very easy. We've been talking to our retail investors, but you will always find that feeling of, okay, let's wait and see.
Let's get into the week-to-week look at how the markets performed over this week. And Gishoy, I want to start with you. I'm looking at the top gainers. I'm seeing interesting names here. I'm seeing Sasidi, Nairobi Business Ventures, Umeme, BK Group, Jubilee Holdings. These are not the usual top movers that we would expect, but what's happening in these top gainers?
It's usually a sign of stagnation. Yes, when the big boys are not really moving up or down, it means that the market has stagnated. So they're not being the top gainers or top losers. And so investors start to look at this, you start seeing the investors who are trading in the smaller, smaller, probably less volume, lower volume stocks, starting to take a front seat. And that's usually what would happen between November, December and January. Because of course now funds are looking, it's holiday time. Everybody is doing something else with their money.
So top losers, Kevin, I'm seeing also very similar ways. I'm seeing Samia, Standard Group, Car and General, CIS Insurance. Your comment on this?
I think for each and every single name that we mentioned there reported losses, or at least a decline in profits, and a good number of them reported numbers in the red. So it's been a tough year, especially for media, for insurance, with all the claims that have been coming. Media with all their operating expenditure having shot up, and traditional media relied on print media. The new consumer is consuming digitally. So I think that has been a big hit on media companies like the Standard. So, but again, as Gishoy mentioned, you'll notice that some of these new names that you see on either the movers or gainers will be there on significantly low volume, 1,000 shares, 200 shares, but they're only, because they're pretty quiet counters to trade. And so once they trade a shilling less than the previous closing price, you find they're 9.8% and you think the company has gone bust. Not really.
Gishoy is the one who's very optimistic today. So the indexes look like they're doing well. I can see the old share index is up by 3.54%, even NSE 20 share index as well, 2.22%, 25 share index as well, 3.83% up. What's happening as well in the indices?
Well, 3-point-something% is really nothing significant. But when I go back, we hit our peak around September, October. And we've seen quite a bit of a downturn on the indices, which tells me that now, because that was a lot of profit taking. So now market is back where we would be telling people it's a good time to take bargains. If you have some, idle money, or we call it disposable income. Let's not call it idle money. If you have some disposable income, this is a good time to pick up the bargains, because now come February, March, if banks announce the kind of results we saw in Q3, in February, March, and the sort of dividends we think would be a signal, I think will be for signaling, especially because it's an election year. Remember, Kenya is a very dividend-oriented, the Kenyan investor is a very dividend-oriented investor. I have a lot of them calling me and saying, how come I didn't receive my dividends? They don't realize the dividends were not paid by several of the companies they hold. So if that happens and there's a lot of dividends or good dividend payouts, then it would mean it would push a rally, maybe during the early part of the year, maybe for Kevin's, to feed a bit on Kevin's pessimism, maybe towards the election we might see a bit of a slowdown, which we saw in to 2013, to, I think 2007, we did see towards the election itself, the market sort of tended to slow, but it did rally earlier on in the year. So I would expect if we're going to get a good dividend year, we might see a good move between March and June.
Okay.
Yeah.
Kevin, I'll close with you. I know you already have a comment on that, but I want you to also add and move and talk about the top movers. Of course, it's the usual suspects. We have this Safaricom, KPLC. Interesting is there, KNGN and KCB as well. On top of that.
It's just what I wanted to add. You know, he added onto my pessimism. I'll add on to his optimism. And I think he says he saw a peak in or sometime around September.
Yeah.
I think partly it's due to the companies that actually declared a dividend. We've seen quite some book closures falling around November, end of November, early December. You know, I think we have 2 companies that are closing tomorrow. I think one of it is NSC itself, 0.5 shilling interim dividend. It's almost 8-9%. So really good dividend. So I think the declarations of the few companies that actually declared a dividend also brought that that boost in the stock market. And there was an expectation that, you know, having come from a full year of the pandemic, you know, the blue chips, you know, your equity, your KCB, your ABSAs will actually declare a dividend. Well, there's the optimism that, yes, they didn't declare for a whole full year and they're going to declare now sometime around, I think it's March.
February, March.
They're going to declare, but it's not to disapprove him.
I was waiting for the but.
Yes, it's not to disapprove him, but I think coming now into an election year where the banks don't know, okay, do we give our money to go? Do we buy government debt? So do we invest in bonds? Or do we then pull off this money from government debt and lend it to the Mwananchi? So the banks will be at at a very difficult place. They'll be in between a wall and a really hard place, where you don't know what to do with the capital. And then for that reason, I think they'll want to preserve as much capital as possible. I'm not optimistic they're going to give a dividend. If I was a CEO or an executive of one of the local banks, I don't think I would give a dividend. Having going just a few months into the elections, I would withhold that money. I better give a special dividend through an AGM after the elections.
All right, there you have it. Some interesting perspectives there. I would want to end with this. You know, this is a Christmas season, as we have said. I would want you to give a tip here and there. And by the way, also answer this question for me. From your observation, did we see greater interest in the markets from especially retailers this time round? Would you say there was a bit of an upscale or it was still stagnant? And what's your hope for next year? So those are so many things to say in one. But yes, your observation in terms of uptake in the markets and in terms of the participation and your message for Christmas to the people. Let me start with you, Gisho.
Yeah, as I said earlier, because of all the idle capital, retail really supported the market. As Kevin said, we can't completely support the market. But considering the level of foreign sell-offs we saw when the COVID pandemic came, the expectation was the market would go much lower than it actually did. And at some point, even for us, it was doom. But yes, the retail investor did step up, and we saw a lot of. And I'm thinking, if you look at things like the flower industries, sort of stopped. The hospitality industry stopped. So many things just stopped. And suddenly we had a lot of people with idle capital, because this was the money they had cash they were using for working capital and all that, and now they had it in cash, and so they needed someone to pack it, and we did see quite a lot of that come to the stock market. Obviously, as the market opens up, then we can expect to see them probably sell off some of what they're holding, and so that could actually go to what Kevin is saying. You could see a bit of a downturn, but remember, markets work on the sort of turnover that is happening.
Your Christmas message.
That's it. My Christmas message. Don't spend what you don't have. Yeah. Don't take credit. So just spend wisely. Spend what you have. The thing is, people will have only 1 week. Children are going on holiday for 1 week. So this is a year where you can save what you usually spend for Christmas. Pay school fees and at least start the year with some extra money that you can invest.
Kevin, over to you.
So I think in terms of retail participation, or generally you and I participating in the local market, I think we've seen quite some uptick if you compare it to previous years. In part, I'd like to thank that to automation.
Yeah.
I think we've seen quite some automation of processes, processes that could take a week, 2 weeks. Opening of CDS accounts nowadays are almost instantaneous.
Lovely.
It's like opening a bank account, You come to a company like us, Jengis, and you have a Jikuze app where from the comfort of your seat, you can just sit and invest. So I think,
as well.
seamlessly. And you can use your mobile money providers to send money and receive money to your account instantly. So I think that automation has been a big foot. And let's get it clear. We can get so many things right, but we don't have the laxative to get the stock exchange wrong. So we really have to push it. I think we are headed in the right direction. NSE will try and throw us a bone here and there. Might be sweet, might be, just there like the day trading. But I think together we are really taking strides. For Christmas, I think it's just tell folks that we've survived this far. Glad tidings and happy holidays.
Lovely. Good way to end, at least very optimistic this time around in the house. That's we had Samuel Gishohi, NCBA Investment Bank, Head of Business Development, and Kevin Gigi, Head of Equities, Jengis Capital, right here, helping us understand how the market was and a look at how we're crossing over. I think generally there was some good energy and, some good advice as well for you for your Christmas. So from my end as well is to wish you a Merry Christmas and a Happy New Year. See you next year. Of course, be wise, spend wisely. It's only 1 week, as Gishohi has said it. And of course, enjoy your time. Bye-bye for now. Trading Bell.
KTN News. Get the whole story.